Hey everybody, Signet here with the OEC. So I'm going to start this video series on why typically people lose money when they trade options. This is mostly going to be focused on new options traders, but I've seen a lot of these same behaviors in people who've been trading options for a couple of years who in the current market are really getting destroyed. Number one, risking too much on any one individual trade. A lot of new traders make this mistake. They will go and aim for very high returns. They want to see thousands of dollars in profit. In the options market, there's only two ways that you're going to even have an opportunity to see really large profit. One is that you match that profit with risk, meaning you are putting in thousands of dollars with the chance or the probability of making thousands of dollars. So you have a very high risk trade, and high risk meaning there's a lot of money at stake. The other way that you can have an opportunity to make a lot of profits is to take a trade that has a very low chance of success, a low probability trade. So risking too much in a trade is the first one that I just spoke of. It's where you're putting up thousands of dollars on the chance that you could make thousands of dollars. New traders believe that they can take a small account and jump into the options market and make a fortune. Well, they don't have a lot of money to risk, so they're trying to make these really big trades and they're risking a lot of their capital to do it. It doesn't work out very well. So each trade is risk. If you have an opportunity to make a lot of money in an options trade, it either has that low probability or it has a high monetary loss risk attached to it. There is a mantra in the options world. You want to get the bumper sticker or buy the t-shirt. Trade small, trade often. Spread out your opportunities and your bias. Be long and short and sideways in different industries, sectors, fields, companies, and in ETFs. Spread out your targets all over. Don't risk a lot of money in one spot. For an example, I could trade NVIDIA. I could go in here and I could buy a call. It's $2,115. And I have unlimited upside potential, and that's a lot of money at risk. Maybe I get 5 of those. Okay, so now I'm up $10,000 at risk. That's a lot of money at risk, and I have a low probability of success. We'll call it 50-50. We could flip a quarter. Maybe I win, maybe I lose. I could instead trade a spread. I could build a position that looks like this. Okay, so now I have $378 at risk, and I'm trading a defined position. Okay, let's make it a round number. So 520 and 525. That's a $5 spread. I've got 260 here at risk. That means I could make 240. Now I could put on 10 of these and make 1,000 if they all run really well. All right. But if I lose here, the maximum I could lose is the 260. I can't lose any more. So while I will make less in this trade, I have less at risk. I could also scale these out, right? If I only had one call, I couldn't scale out. I would have to lock in profits. But instead of buying one call and spending $2,000, I could buy 10 of these and spend $2,000. And then I could take some off at 20%, some off at 40%, maybe some off at 50 or 60%. Right? I can scale out of the position and lock in my gains because I'm not trading too much. Right? I'm not putting too much in any one individual trade, like just buying that single call. Another reason that people tend to lose money when trading options. Trading things that aren't liquid. Now, this is a really big one that a lot of people sleep on and they just don't notice it. When you're trading a product that's not very liquid, the bid-ask spread is very wide. We're going to go look at something called IYR. This is the U.S. real estate ETF. There's a 30-cent spread in here, and that's not too bad, I guess. Right? It's not horrible. 30-cent wide spread. And if I'm only going to do one option, then I'm going to slip somewhere in the middle of that. Right? But what about when I have two options? Now I've got to get the mid between these two and the mid between these two. Okay? There's a lot of slippage to get into this trade, and then a lot of slippage to get out of this trade. When you're trading something that's more liquid, the bid-ask is a lot tighter, maybe 3 to 5 pennies. All right? So that's one way that trading things that are not liquid can cause you to lose. When you need to see a bigger move just to get to break even, you might not even get to break even, causing you to lose. Plus the monetary loss at the end of the year from all that slippage, while you don't actually maybe see that negative value, it was money that you didn't make. It was money that you lost and did not get. So it is a loss. The other thing about trading illiquid underlying markets is the idea that there might not be a lot of strikes to choose from. So here is X Steel, and it looks like X Steel has a lot of strikes to choose from. But in reality, it doesn't. Look at all of these strikes that are bag holders. There's nothing here. All right, so there's really not as many choices here after all. Another thing is, look at something like Facebook. See how it's $2.50 wide. If Facebook was really liquid, it would have more strikes, maybe $1 wide strikes or 50-cent wide strikes. So when there's not as many strikes being offered due to a lack of liquidity, then an options trader who's new will choose the options that are left. They'll choose what they see, never realizing that those were bad options choices on a bad options market, and that you should have avoided the whole thing completely and just found something else to trade. So trading things that are not liquid can cause a lot of losses to new traders. Trading low probability strategies. Directional versus strategic strategies. Directional trading in the options market, they lose more than any other trade strategy. I can't stress this enough, and you need to stop and let it sink in. Directional trades lose more than any other trade. I heard a statistic that they lose more than all other trades combined, but I can't remember where I saw that, so we're not going to lean on that. I'm not going to say that that's fact, but it is a fact that they lose more than any other trade strategy. Most people are not very good at picking direction, especially new traders. When it comes to options, you don't just need to pick direction. You need to pick how long it's going to take to make that move in the right direction. If you get that wrong, you're going to lose. So trading directionally is going to cause you to lose a lot. That's not my opinion. I'm not guessing about that. It's a fact. A directional options trade is a low probability trade. And remember what we said about low probability trades earlier. Okay? Without a very strong move in the market, a directional trade won't offer much payout. I know that nobody wants to hear this, but unless you get into a directional trade that is absolutely rocking and rolling, in the near term, it's not going to make you any money. And that thing has to move. If you're taking a long-term trade and it's a directional play, it still has to make the move. But you would need options that are far out in time, and that means that they're not being priced in a dollar-to-dollar move with the market. So the market moves a dollar, and maybe you see 30 cents on the dollar. So it's a lose-lose situation. If you use near-term options, you're going to get volatility crushed. And if you used farther dated options, then they're not going to make a dollar-dollar move with the market, and you're probably going to make about 30 cents on the dollar. So you're going to really need to see that market move, which is again why trading directionally is hard for new options traders to do. Not trading frequently enough. This one is almost counterintuitive, and it is hard for new traders to do who can't find things to trade or don't have the account size to run a lot of positions. You need to trade a lot. Remember what we said before. Trade small, trade often. When I was new to trading and still working a day job, I had over 180 trades running at any one time. 180 trades plus. Now I was able to do that even in a small account because I traded things that were very liquid, that had 50-cent wide strikes, and I put on a lot of trades. Options is a probability-based model to trade. If you only take 3 trades on the year, no matter what your strategy, you could lose all 3 of those trades. But if you was to put on 3,000 trades in a year, and you're trading good, clean, high probability trade setups, you will do better than a 50-50. We can flip a quarter 3,000 times and get head or tails half the time. That's statistical fact. So even if you completely and totally suck at picking direction, the law of probability says you can win at least 50% of the time on accident. With just a little bit of effort, we can do better than 50%. We can do better than 60, 70, and better than even 75%. But you have to trade a lot, which takes us back to the earlier discussion where we said don't trade big. Trade a lot and trade small in every one of those. Not considering IV in your decision-making process. Now this is another big one. When you're building an options trade, you need to understand what you think volatility is going to do. You need to look at it. Is it high? It's a cyclical product, so when volatility is high, we say it has nowhere to go but down. If it's low, then we say it has nowhere to go but up. If we see an earnings on the horizon, we know it can go up. We also know that after earnings, it's going to go down hard and fast. So if you can anticipate the direction of volatility, you can build a trade that will work with volatility instead of working against it, or you can try to build a trade that protects you from volatility. On protecting yourself from volatility and or working with volatility, of course there are certain situations where it doesn't work very well or that you can't do it, right? For an example, volatility crush at earnings. There's really no way to protect yourself from that. So, everything has limitations, but if you're not looking at implied volatility, then you're not choosing the options trade that fits the kind of volatility that you could anticipate during the life of your trade. And that means you're going to be blinded when volatility goes against you and takes a lot of your profit or hurts your position. So you can work with volatility or you can ignore it. And if you ignore it, it's going to kick your butt. Letting profits run and cutting losses short. This is another one that new traders with options make a mistake on a lot. And I think it really goes back to the fact that most people start in stocks. And they're taught that when you're in a good, strong stock and you're expecting that stock to continue to grow as a company, that you want to let your runners run and cut your losses. That makes perfect sense. But this isn't stock. This is options. And when you're in a probability-based trade and you have defined risk, you need to not manage your losers. You've already managed the trade when you built it. The size of the position that you built was how you managed your risk in the trade. You don't manage the trade even more beyond that. And if you do, then it needs to be set with very specific criteria, meaning near expiration. You want to give an options trade time to mature. A lot of these trades make money as time goes by. So while they might start out almost immediately putting you in the hole, you don't want to lock in that loss. You want to give the trade time to grow and to mature and to be profitable. On the other hand, with winners, you want to lock in those profits. An options trade, a lot of options trade decay in value. So the longer that you're in them, the more they decay, the more money they lose, especially in those directional trades. Okay, so how you build the trade can work with you or against you on this, but the main thing is to lock in profits. A lot of trades that are time-based, like a credit spread, those you want to close them and make a new trade. That to stay in them all the way to expiration will tie up so much of your capital that you could have been using in a market that is moving again. Right? So the proof is in the pudding. You will make more money year over year returns if you close those credit spreads early and open a new one rather than staying in them all the way to expiration. Okay? And you will increase your win rate by managing that trade early. There's been a lot of work proving the numbers on this. You will win more often and make more money year over year if you close the trade with profit locked in and open a new one. One of the most popular lock-in targets is 50%. Closing a trade at 50% is what most people consider their max profit. That's their, as long as they're willing to stay in it and they move on to a new trade. Not exchanging your unlimited profit strategies for the higher probability of profit strategies. And this is a big one. There's always a time and place for the different strategies that are out there. That's why there are so many of them. They're not universally applied. Some markets do really well with some strategies, and some markets do really well with others. So you need to have an understanding of when to use a directional trade or when to use an unlimited profit trade. And then you need to understand when it's more appropriate to use a higher probability of profit trade. The idea that you could make a lot of money, hey, that's great. When you think about putting on a large trade to make a lot of money, think about how low your chance of success is. Statistically, it's low. So you have a chance to win a lot, but you have a low chance of actually doing it. If you need help with what I just said, think about going to the store and buying a lottery ticket. You have the chance to make a lot of money, but you don't have a very high chance of making a lot of money. Okay? That's a directional trade. On the other hand, you could build a high probability trade, a trade that has a very high chance of success. We know exactly how to build trades with a high chance of success. Remember what I did say earlier, though. When you have a trade that has a high chance of success, it's not going to come with very much reward. Why? Well, because who would take the other side of that trade? If you and Joe are standing next to each other and Joe says, I'll bet you $1,000 that I can lay down on the ground. Well, would you take that bet? I'm almost sure that Joe can lay down on the ground. It's a high probability for Joe. Do you want to really bet against him? No. And if you do, it'll probably be because you see some edge in it. But you're still not going to want to do that for an even amount of probability, right? For an even amount of money. One of you is going to have to give up some edge somewhere. So when you have a very high chance of success, finding somebody else to give you a lot of money at play on that is very unlikely, right? because the other person is going to have a very low chance of success. The other idea when it comes to unlimited profit for high probability trades is the idea of unlimited profit sounds so wonderful. Of course it does. Everybody wants that unlimited profit. It even sounds good, right? I'm getting in a trade that has unlimited opportunity. Yeah, man, that sounds great. The problem is most new traders don't hang on to it long enough to get that unlimited profit. They start to see some profit, they get excited, and they think, oh man, I got to close this thing out before I lose. They close down the trade and the market just keeps on running. And then they say, oh shoot, I should have stayed in that thing. So then the next time they start to see some profits and they think, nope, I remember what happened last time. I'm not closing this thing down. I'm going to hang on to it. And then the market stalls and begins to fade back, and they start to lose all of those profits that they saw but didn't lock in. And then maybe they break even or they get a little bit of profit again, right? So unlimited profit sounds really great, but since a new trader fumbles the trade anyways most of the time, they're not going to get that unlimited gain. So that's it, guys. That's the list. This is why people typically lose when trading options. The good thing is all of the things that I mentioned are simple to fix. Isn't that great? It's not complicated at all. You don't need a special thing to be able to resolve all of these issues. The only thing you have to do is learn more about every one of these issues and how to turn the tables to make sure that you're not doing one of these. Real quick before I end the video, guys, like and subscribe. Help me get this channel growing. I completely appreciate it. I appreciate your time, and I look forward to seeing you at the next video.